Welcome to the Wealth Studying Podcast. This is episode 488. Today is August 14th, 2025. I'm your host, John Pagliano. I'm also the founder and money manager at investablewealth.com. Well, if you're looking at the headlines, the news, the financial news, today is all abuzz about how PPI inflation is higher than expected and, oh my goodness, wholesale prices are surging. And if you're a long-term listener to the podcast, you're ignoring these headlines because you're smart enough to remember that literally just earlier this week on Tuesday, the headlines were proclaiming that CPI inflation was slightly higher but under control. And because of that, the market was pricing in a Fed rate cut in September at like 99% occurrence. And you just go back a few months earlier, and there was almost 0% chance that the Fed was going to cut rates in September. Listen, it's all nonsense, and that's why today we're not going to even talk about inflation other than to say, I've gotten your feedback that you do want me to do a podcast on stagflation, so that's going to be coming up here in the queue in the near future. And the reason I'm not jumping on the media bandwagon and talking about inflation nonstop like everybody else, and the reason I'm going to put this off into, a week or so into the future, is because I don't think inflation is a problem. Not the way the media portrays it anyways. So for now, sit tight, and I promise there'll be an episode addressing a lot of these media concerns about stagflation and tariff inflation. But in today's episode, I want to talk to you about something that's so much more important than that. It's really, I'm doing air quotes here, but it's the secret to building wealth. I didn't use that in the title because there is no secret to building wealth. It's all nonsense marketing. Building wealth is just like the thermodynamics of money. You obey certain laws of economics and you become wealthy. We'll get to all that in a second, though. I first want to mention that I recently was on the Living Free in Tennessee podcast with my good friend Nicole Sauce. And I'd encourage you to take a look at that video. I've got the link in today's show notes. It's on her YouTube channel. And what's unique about this particular interview is, I'm normally talking about building wealth and the nuts and bolts of the economy and things. But Nicole took this interview in a different direction. And yes, we definitely talk about money and wealth and career success and, all the things that I talk about with wealth studying. But she asked a question that led us down the path more on the level of spirituality and, influences that I've had earlier in my life, religious type experiences and things. So definitely a unique approach to wealth studying. Check that out. You'll hear in there mentioned too that on October 4th and 5th, I'll be in Camden, Tennessee. Nicole is hosting the Self-Reliance Festival there. I've talked to that event in the past. I will be there this October. I'll get an official link and things out in the future. But for now, if you go to selfreliancefestival.com, you can sign up for tickets. You can use wealth studying and get a 10% discount. And again, I'll talk more about that in the future. In addition to talking about wealth and things out there, I'm planning on having a really unique setup with my little travel trailer and hopefully a hex beam antenna that I'll be displaying not only ham radio concepts to people, but also relating that to the analogy of life and how we can have success with our career and wealth. And if you wonder how I can tie all that together with ham radio, well, hey, come on, check out the event in October. Oh, and by the way, this is not my event. This is totally Self-Reliance Festival. I'm just attending as a speaker. I will be there for the whole weekend. If we get enough response, we will put together some kind of a wealth studying meetup, and more about that in the future. Right now, though, let's boil down and ignore the headlines. Let's not care about whether there's hyperinflation on the future or whether we're going into a period of 1970s style stagflation or whether tariffs are going to raise prices. Here's the bottom line. And again, I'm doing air quotes because I'm going to tell you the secret to building wealth. It's about owning appreciating assets. That's it. It's a 3-step process: earn, save, invest. It doesn't matter if you're a high income earner if you spend everything and more that you make. So sure, you got to earn and save. But when it comes to that investing part, building wealth, whether individually or generationally, is no more than owning appreciating assets. And even in your own personal life or in your career, it's just about developing the appreciating asset of yourself, your own God-given talents. No, you're saying, but John, inflation, stagflation, tariffs. Just remember this. Assets, whether we're talking about real estate or stocks or the business that you own, they're all priced in dollars. But you could just as easily price them in Chinese yuan or Japanese yen or European euros or Bitcoin or some crap coin. The currency is just a measurement in that particular medium of trade, to just a set of value for a transaction. And so if there is tariff inflation or hyperinflation or whatever, that generally is going to be related to monetary policy. That means the purchasing power of your currency goes down. Again, whether it's euros or dollars or yuan. But it doesn't matter because your wealth isn't in money or currency. Your wealth is in the asset. And so the asset is just priced higher. This is such a simple concept. People just don't get it. And so whether you're just trying to keep up with inflation or whether you're trying to get a real rate of return, the way to do that is by owning an asset that's going to appreciate and hopefully appreciate higher than the rate of inflation. I'm not going to get specifics into the nuts and bolts and fundamentals in this episode because, I've talked about it a million times and I'll talk about it a million more in the future. So I'm not going to get in the nuts and bolts of fundamentally what makes an appreciating asset or why some stocks are better than others. But I just want to key in on that secret to building wealth. And to put it more bluntly than simply owning appreciating assets, the real secret, and this mitigates a lot of the risk that people have because people are so risk averse, especially now with the market being at record highs. And hey, don't get me wrong, I'm sitting on 20% cash. I do think a lot of the headline fear of missing out stuff has gotten a little frothy. I would love to see a pullback, especially if there is inflation fears, and I'm just going to go in and buy the dip. But long term, my 1,000% strong conviction is that good quality United States stocks are going to keep going up long term for a number of reasons. The biggest reason being that they're profitable. That's what makes them good quality companies and stocks. And as they grow their profits, their price appreciates. That's why they're appreciating assets. They become more valuable. I own, close to 140 stocks right now. Everything from railroads to copper mines to nuclear power plants to uranium processing facilities to Facebook and Google and Amazon, right? The whole literal ball of wax. The reason that broad diversification works, and it's not simply just a buy and hold strategy or just invest in the S&P 500, but it boils down to the fact, and this is the indisputable, quote, secret of building wealth. Losses are limited, but gains are infinite. Okay, and this is why the S&P 500 works. Just simply dollar cost averaging into the S&P 500, it works. But stock picking or having a portfolio of individual stocks works as well, or in some cases better, because what is the S&P 500? It isn't magical. It's simply picking 500 stocks. If you choose to put together your own, quote, ETF or a portfolio of your own broad selection of stocks, as long as you do it in a manner that does mitigate risk and is truly diversified, then you're going to see, good long-term performance because you're continuing to invest in growing profitable companies and you're selling and shedding off the unprofitable companies. That's exactly how the S&P 500 works. It's not about buy and hold. The S&P 500 doesn't buy 500 stocks and keep them for 20 years. Every month, every quarter, they're adjusting what companies are in that S&P 500. So the winners become a bigger part of it and the losers get taken out of it. You can do that by constructing your own portfolio as well. But it all comes down to that air quote secret of building wealth. Assets appreciate because losses are limited and gains are infinite. Let me give you a real world example of what that means. In my portfolio right now, I would say my worst performing stock is a company named Celanese. It's a specialty chemical company. I'm going to do an episode in the future about how these chemical companies have been in a very long-term multi-year low. I thought they were coming out of it last year. They didn't. I may decide to take the loss and sell them and move on. I may not. Again, we'll cover that in a future episode. But bottom line, right now, Celanese is down more than 70% from what I bought it for more than a year ago. Now, I'm not happy about that, but I also don't lose any sleep over it because you heard me say I own close to 140 different stocks or positions. So if one of them is down 70%, again, not happy about it. I never like to lose money because I don't hate money. But at the same time, the most I can lose in Celanese is what I invested in it because I'm not using leverage or I'm not using naked or uncovered calls or puts. And the worst they can do is go to zero. And so the most I can lose is what I invest in them, right? Losers, right? Losing positions have limits. You can only lose what you invest in them. And if you're diversifying your portfolio, that means you're not putting all your eggs in one basket, right? You're not taking your life savings of $1,000 and buying one stock with it. In the case of Celanese, if it goes to zero, I'm going to lose just a fraction of my overall portfolio. I will certainly lose less in my portfolio than the amount that my overall portfolio is down today just because the market happens to be down. What I'm trying to point out here is it's relatively insignificant. And again, I don't want that to happen, but I want to construct a portfolio in such a way that if 1 or 2 or 5 or 20 of my positions do extremely poorly, that I still have enough better positions that are going to make up for it. Because while the losses are limited, the gains are literally infinite. And so some of my top performing positions right now, and this changes from day to day and depending upon how you slice and dice the portfolio, it's not exact, but broadly speaking, just to give you an idea of what I mean by this. Sure, Celanese down over 70%. But you know what? Centrus Energy up well over 300%, right? 300%. And other companies just moving, way down the performance list. But, here's a twin pair of companies, GE Aerospace, easily up nearly 70%. GE Vernova up, a good 60, 65%. So either a specific gain or even a portion of some of my huge high performers easily make up for the losses generated by the losing positions. And again, I have to stress this. The most I'll ever lose in Celanese, if I lose anything long term, will be just the amount I invested in it. How much will I earn over the coming years from things like Centrus Energy, or Valero, or ExxonMobil, or Shopify, or Chevron, or NVIDIA, or Jabil, or Sienna, or Constellation Energy, or Howmet Aerospace, or Amphenol, right? I could just go on and on about other winning and gaining positions in my portfolio. And so, yeah, I'm not happy about losing positions, but long term, if you're investing in appreciating assets, regardless of what the headlines say or where the markets move day to day or even month to month, but long term, those losses will always be limited and the gain potential of the winners will be infinite. Keep that in mind. Whenever you buy a stock, you buy it once. But until you sell it, you're entitled to all future earnings of that stock into perpetuity as long as you never sell it. So rather than worrying about the nonsense about what the talking heads are saying day to day, focus on buying and owning good quality appreciating assets. And then you'll be like me, and you'll be a cynical optimist. Well, hey, that's what I got for today. As always, until next time, this is John Pugliano wishing you the very best returns.